Okay, let's unpack this. We've got quite a stack of sources here. Articles, research, notes, all focused on a really important topic for, well, for a lot of people.
Uh,
Investing for retirement when you're starting later, specifically after age 50.
It's a situation many find themselves in, and honestly, it can bring up a fair bit of stress. That feeling of, maybe having missed the boat, the clock ticking louder.
Yeah, and the sources really acknowledge that emotional side right away. There was a 2022 survey mentioned. Only 22% of Americans near retirement felt they'd actually saved enough.
Just 22%. That number really tells you this isn't some rare edge case. It's common.
But here's where it gets interesting, and this is the goal of our deep dive based on this material. Cutting through the noise, pulling out the most practical, actionable strategies.
Exactly. Because the sources are clear. Yes, there are challenges, absolutely.
Hmm.
But strategic, disciplined action can make a significant difference, even with a late start.
So for anyone listening who feels like they're behind or just wants to make the most of these crucial working years, this deep dive is definitely for you.
We're going to look at the reality, the challenges, figure out how to honestly assess where you stand right now.
Explore ways to really accelerate those savings, manage investments differently, perhaps.
Think about creating income in retirement, which is key. And also touch on when getting professional help might be, well, essential.
Okay, so let's start with facing reality. The challenges, figuring out that starting point. We mentioned the stress, that statistic. What are the core financial hurdles someone starting serious saving after 50 is really up against?
Well, the big one, the primary challenge, is simply time. Limited time. You have fewer years for your money to grow.
And crucially, less time for compounding to work its magic.
Precisely. You need to actively compensate for that lost time, that lost growth. Plus, you're dealing with inflation and market swings with a much shorter runway until you actually need the money.
Less time for the market to recover if there's a big dip right when you plan to retire.
Exactly. That's a major risk.
Yeah.
Less margin for error.
But as you said, the sources aren't all doom and gloom. They really emphasize that aggressive saving and strategic investing can still significantly improve things.
Absolutely. It's not just theoretical. It requires focused effort, maximizing the tools you do have available now.
Which brings us to the first step, reassessing. Goals, current position. You can't plan the journey without knowing the start and end points, right?
You really can't. It's fundamental.
So how do you even begin that? What are the practical questions someone needs to ask themselves based on this material?
First, define what retirement looks like for you. What's the desired lifestyle? And, crucially, what might it cost?
So things like, will life cost about the same? Are you planning to move somewhere cheaper, maybe downsize?
Right. Or are there potential big costs, like health issues you anticipate? Do you want to travel a lot, help out grandkids?
And the sources stress being realistic here, maybe even a bit frugal, especially when you're playing catch-up.
Very much so. No room for overly rosy estimations when time is short. You need a clear picture of the goal.
Okay, that's the goal. What about the starting line? Understanding your current finances.
Analyzing income, expenses, and debts. A really practical tip mentioned is tracking everything you spend for, say, 3 to 6 months. Get a real, accurate average.
Don't forget those sneaky annual or semi-annual bills, too.
Definitely not. Budgeting isn't just suggested here. The sources frame it as absolutely fundamental to finding where you can free up cash.
And I imagine debt is a huge roadblock to freeing up cash for saving aggressively.
Oh, absolutely. It's highlighted as a major obstacle. You need to tackle it. Think about it. Average U.S. household debt in 2022 was apparently over $155,000. Getting rid of high-interest debt. That frees up funds immediately for retirement savings. It's like getting an instant high return because you're avoiding those interest payments.
Okay, income, expenses, debt handled. Then how do you figure out if your current savings are anywhere near what you'll actually need?
You need to estimate the total amount required for that comfortable retirement you defined earlier. The sources give some pretty eye-opening example figures.
Just to give a sense of scale.
Exactly. For instance, if you're 50 now, want $50,000 a year in retirement income, you might need somewhere between, say, $900,000 if you retire early at 60.
Wow.
Down to maybe around $200,000 if you push retirement out to 67. And if you're aiming for $100K a year, the numbers jump significantly, potentially needing close to $1.8 million at 60, or maybe $380,000 at 67.
Those are big numbers, especially daunting if you feel like you're starting from behind. This really feels like the point where trying to figure it all out alone could be overwhelming.
It definitely can be. And every decision feels heavier with less time. which is why the sources strongly suggest considering a fiduciary financial advisor.
Especially for late starters.
Especially for late starters, there's just less room for missteps. An advisor can help with refining the budget, creating personalized projections, building that specific plan.
Making sure you're using things like catch-up contributions effectively.
Yes, maximizing those. Guiding your investment allocation, helping you manage those specific critical risks, like that sequence of return risk you mentioned. That one's particularly dangerous for this age group.
Sequence of return risk. Okay, we definitely need to circle back and unpack that one properly later. It sounds crucial.
It is.
But first, okay, you've assessed where you stand. Now, the next step is turning up the dial, accelerating savings. What are the specific tools for people 50 plus to really boost contributions?
Well, this is where the system actually gives late savers a leg up. You can use catch-up contributions.
Right, in accounts like 401ks and IRAs.
Exactly. They're specifically designed for people typically age 50 and over, letting you put in thousands more each year above the standard limits. It's meant to help make up for lost time.
And the tax advantages of these accounts are key to making those extra contributions work harder.
Absolutely fundamental. Traditional accounts like a standard 401k or IRA reduce your taxable income now. That's an immediate benefit, frees up more cash today.
And Roth accounts.
Roths are different. You contribute after-tax money, but then withdrawals in retirement are completely tax-free. This can be really powerful if you think you might be in a similar or even higher tax bracket later on.
Like maybe from pensions or part-time work in retirement, bumping up your income?
Potentially, yes.
Right.
So choosing between traditional and Roth is a form of forward-thinking tax planning. It protects your future income.
So it's not just how much you save, but strategically where you save it. And given the late start, is just hitting the standard limit plus the catch-up enough? Or do you need to push harder?
The sources are pretty clear on this. An aggressive approach is needed because you started late. It means making regular, maximally possible contributions, squeezing every available dollar into these accounts.
So combining that aggressive saving amount with the smart use of tax accounts, maybe including Roths, that's the engine for catching up.
That's the dual strategy, yes. Faster capital growth and optimizing your future income and tax situation. It's how you power the catch-up.
And how does maximizing contributions, especially in those tax-advantaged accounts, specifically help fight something like inflation? We know that's a big concern.
Right. Inflation is that silent erosion of purchasing power. By maximizing contributions, especially in these accounts, you're directly fighting back.
How so?
Well, traditional accounts lower your taxable income now, leaving more money in your pocket today, effectively shielding some current income. And Roth accounts give you that tax-free income later, meaning every dollar withdrawn keeps its full purchasing power.
So it preserves more of your real wealth when you actually need to spend it.
Exactly. It's a structural way these accounts help protect your savings from rising prices over time.
Okay, so assess, save aggressively using all the tools like catch-up. Now, step 3, navigating the market maze. Investing that money and managing the risks, which, as we said, feel bigger with less time. How does risk tolerance typically change after 50?
Well, naturally, as you get closer to needing the money, your ability to ride out big market drops decreases. The time horizon is shorter.
Less time to recover.
Precisely. So this usually means shifting towards a more conservative investment approach than, say, in your 30s or 40s. A big market crash just before or right as you retire can be devastating if you don't have decades for things to bounce back.
So the general advice shifts towards dialing down the risk.
Yes, the sources point to increasing your allocation to bonds as a key strategy here. Bonds are typically less volatile than stocks, providing more stability as you approach retirement.
But wait, you can't just pile everything into bonds, can you? Doesn't the money still need to grow somehow?
Exactly. That's the crucial balance. Capital preservation becomes more important, yes, but maintaining some level of growth-oriented investment stocks typically is still essential for most people.
And why is that growth still needed, even when stability feels so important?
Primarily, inflation. The sources explicitly say inflation erodes the real value of assets. If your investments don't grow faster than inflation, your spending power shrinks over time.
And people are living longer too, right? That longevity risk the sources mention.
That's the other key factor. Your money might need to last 20, 30 years, maybe even longer in retirement. So you need growth to outpace inflation over that long haul. It's about finding that balance. Stability from bonds and growth from stocks to make sure your money lasts as long as you do.
That makes a lot of sense. It's not an either, it's about the right mix, and that mix changes.
Right. And diversification is still key. Across different asset classes, stocks, bonds, cash, maybe real assets, and within those classes, across different sectors and regions. Your allocation should match your risk tolerance and the return you need, but generally the closer you are to needing the cash, the more conservative that mix should be.
Do the sources give any specific examples of how that allocation might shift?
They do offer some general guidelines presented in a table, actually. For someone aged 40-50, maybe 60-70% stocks, 30-40% bonds. But as you get closer to retirement, say 50 plus bond, that could shift significantly, maybe down to 30-40% stocks and 50-60% bonds.
A noticeable shift towards safety.
Yes. And the source also mentions an average mix for U.S. 50-year-olds. Roughly 40% U.S. stocks, 8% international stocks, and about 9% total bonds. It clearly shows that trend towards reducing stock exposure.
Okay. And when you're building this portfolio, what types of investments are recommended, especially thinking about diversification and keeping costs down?
The sources strongly lean towards low-cost index funds, or ETFs, exchange-traded funds.
Why those specifically?
They give you broad diversification exposure to hundreds, sometimes thousands of stocks or bonds all in one go, and usually at a very low cost. And minimizing those fees, the expense ratios, is critical when your time horizon is shorter. Every fraction of a percent saved on fees goes directly to your bottom line.
Less money leaking out over time.
Exactly. They offer that broad diversification cheaply without the complexity or often higher costs of actively managed funds.
And once you set that mix, say 40% stocks, 60% bonds, you can't just set it and forget it, right? Markets move.
Absolutely not. Regular rebalancing is crucial. The recommendation is at least annually.
Why rebalance?
Because market movements will naturally drift your allocation away from your target. If stocks have a great year, suddenly you might have 50% stocks instead of 40%, meaning you're taking on more risk than you intended. Rebalancing just means selling a bit of the winners and buying a bit of the losers to get back to your target mix.
Maintaining that intentional risk level.
Precisely. Keeping it aligned with your plan as you get closer to needing the money.
Okay, we've touched on some risks, but let's really dig into the key ones for retirement planning, especially amplified for late starters. We mentioned longevity risk, living longer than expected.
A big one. It's great we're living longer, but financially it means your nest egg needs to stretch further, maybe 20, 30 years or more. That requires a solid plan and, importantly, diverse income sources. We'll get to those.
Okay, and withdrawal rate risk, taking out too much too soon.
Yes, especially if you start with a smaller pot of money. The 4% rule is often mentioned, withdrawing 4% of your portfolio in year one, then adjusting for inflation. But the sources rightly caution it's not foolproof.
Not a hard and fast rule.
No, especially in volatile markets, or if your personal needs change. You need flexibility. Withdrawing too much, particularly after a market drop, can seriously deplete your savings faster than planned. That risk is higher if your starting capital is lower.
Which ties back into market risk, the impact of downturns being magnified.
Right. As we said, less time to recover. It's why managing volatility and becoming more conservative near retirement is so critical.
And finally, that one you flagged earlier, sequence of return risk. It sounds technical, but the sources stress its importance. Can you break that down?
It's really critical. Sequence of return risk isn't about your average return over, say, 20 years. It's about the timing of those returns.
How so?
Getting hit with bad returns, negative returns late in your saving years, or even worse, right when you start withdrawing money in retirement, can be devastating. It can rapidly deplete your capital in a way that's hard to recover from, even if your long-term average returns look okay on paper.
And why is this especially dangerous for late starters?
Because they usually have less accumulated capital to cushion the blow. A significant loss early in retirement, when you start taking money out, has a disproportionately large impact on how long the rest of your money will last. Protecting capital from those early losses is paramount.
So that shift to a more conservative allocation isn't just about feeling comfortable, it's actively mitigating the sequence risk.
Exactly. It's a key defense mechanism, along with building other income sources so you're not forced to sell investments when the market is down.
So these risks, longevity, withdrawal rate, market, sequence, they're all tangled together, and for someone starting late, they feel more intense, more compressed.
That's a good way to put it, compressed and amplified. The sources emphasize that the plan needs to be holistic and adaptive, not rigid. You need to be able to adjust withdrawal rates if needed, based on market performance or life events. And prioritizing diverse income streams becomes crucial.
Okay, speaking of income, let's move to that. Building your retirement paycheck. Relying only on selling investments seems risky, as you said, especially if the market tanks right when you need cash. What diversified income sources do the sources talk about?
Dividend stocks and ETFs are a common suggestion. The idea is they provide regular income, the dividends potentially, without you having to sell the underlying shares.
So you get cash flow and maybe the investment itself can still grow.
That's the goal. The sources mention a few examples just to illustrate.
Like what?
Well, there's VOO, the Vanguard S&P 500 ETF, gives you very broad diversification across big U.S. companies. Its yield is noted as around 1.3%, paying about $7 per share annually based on recent data.
Okay, broad market, lower yield.
Then there's SCHD, Schwab's U.S. Dividend Equity ETF. It focuses on companies with a strong history of growing dividends, yielding significantly higher, around 4%.
More income focused.
And they mentioned, Realty Income. It's a REIT, a real estate investment trust. Pays dividends monthly, which people like, long history of growth, and a yield around 5.8%.
And there's a table comparing these in the sources.
Yes, showing the tickers, yields, how often they pay. Recent performance, though, remember, past performance is no guarantee expense ratios and key features. It's a helpful snapshot for comparison.
That Realty Income yield, nearly 6% and monthly pay. Sounds very attractive. But I see a cautionary note in the material about its payout ratio. What's that about?
Ah, yes, that's a crucial detail. A good reminder to look beyond just the headline yield number, especially when protecting capital is key for late starters.
So what's the issue?
The source notes O has a very high payout ratio listed at over 280%. In simple terms, based on that data, it means it's paying out way more in dividends than it's currently earning.
That doesn't sound sustainable.
It can be a red flag. While high yields are tempting, a payout ratio that high might signal the dividend level isn't sustainable long-term unless earnings grow significantly. For someone needing reliable income and capital preservation, understanding this risk is vital. Plus, remember, even dividend stocks fluctuate in price. There's still market risk.
Good context. Okay, what other income strategies are mentioned?
Bond ladders are discussed. This involves buying several individual bonds that mature at different times. Say, one matures next year, another in 2 years, 3 years, and so on.
Staggered maturities.
Exactly. As each bond matures, you get your principal back, which you can then reinvest, maybe in a new bond further out. It provides a relatively predictable income stream from the interest payments and helps manage interest rate risk because you're not locking all your money up at one rate.
What about annuities? They always come up in guaranteed income discussions.
Yep, they're covered. Annuities are insurance products. You give them a lump sum, and they promise to pay you a certain amount regularly, often for life. The big appeal is that guaranteed income stream you can't outlive.
But there are downsides.
The sources mention limitations, yeah. Like liquidity, it can be hard or expensive to get your lump sum back if you need it. And fees can sometimes be high, so you need to understand the contract fully.
Okay. And what about government pensions? Like Social Security in the U.S.? For many, that's the bedrock.
Absolutely essential for many retirement plans. And the key strategy discussed is maximizing those payouts by delaying when you start taking benefits. If you can wait past your full retirement age, up to age 70, your monthly payment increases significantly through delayed retirement credits.
It's often called one of the best investments available, right? That guaranteed increase.
It really is, offering a guaranteed inflation-adjusted income stream for life.
And even part-time work in retirement gets a mention.
Yes. The sources note that even working part-time can make a huge difference to financial stability. Imagine combining a maximized state pension with some part-time earnings.
Creates a solid income floor.
Exactly, a guaranteed or semi-guaranteed income floor. That reduces how much you need to pull from your potentially volatile investments, which directly mitigates withdrawal risk and sequence risk. It builds a much stronger foundation, especially for late starters.
Are there any more, maybe less common income strategies mentioned?
Yes, they touch on covered call options. It's an option strategy. Basically, if you own shares of a stock, you can sell someone else the right, but not obligation, to buy your shares at a specific price by a certain date.
And you get paid for selling that right.
Exactly. You collect income upfront, the option premium. The trade-off is you limit your potential profit if the stock price shoots way up past that agreed price, because you might have to sell your shares.
So income now in exchange for potential future gains.
That's the trade-off. It's described as relatively lower risk compared to other option strategies and popular with some older investors wanting income from stocks they already hold. Best used, perhaps, when you don't expect huge price swings or when income is the main goal for that holding. It's a specific tool, not a universal solution.
Okay, so we've covered assessment, aggressive saving, smart investing and risk management, and diversifying income. That's, well, a lot to juggle, especially when the stakes feel higher starting late. When should someone really consider calling in the pros, according to these sources?
The sources consistently circle back to this point. While you can do a lot yourself, consulting financial professionals provides tailored advice for your specific, unique situation. The fact that this recommendation pops up repeatedly really underscores the complexity here.
Especially for late start planning.
Especially then, the path is less forgiving.
And why is that professional layer so valuable in this context? What can they offer?
Well, advisors might see strategies or angles you haven't considered, especially in complex areas like optimizing taxes across different accounts, planning for inheritances maybe, or really stress testing the plan against risks like sequence risk.
Getting that objective expert perspective.
Right. When the timeline's shorter, every decision counts more. Getting expert help to fine-tune the plan, maximize contributions, manage risk appropriately, it can be invaluable.
The sources even mention some specific localized examples, things like accessing certain brokers or understanding local investments. How does that illustrate the need for advice?
It's a great illustration of how individual circumstances add complexity. The sources mention, in a specific context, navigating access to international brokers versus local options, like particular government bonds or even local real estate or specific REITs.
So things that are very specific to where someone lives or what they have access to.
Exactly. Understanding those local market nuances, the specific tax rules in your jurisdiction, accessing the right platforms, that adds significant complexity beyond general advice. A professional advisor in your area should be equipped to navigate those specifics and ensure your plan uses the best tools available to you.
That makes perfect sense. It's not just applying universal rules, but applying them to your specific, potentially complicated reality.
Precisely. The stakes are higher, so that personalized expertise often matters more.
So wrapping this up, what's the big picture takeaway from this deep dive? Starting retirement investing after 50 clearly has its challenges. The clock, lost time, managing risks differently.
Definitely challenges. But the powerful insight from these sources is that it's not hopeless. With discipline, strategic action really hammering those catch-up contributions, investing smartly with that balance of risk and growth, and focusing on diversifying income, a secure retirement is still achievable for many.
It requires that honest look at where you are, being aggressive with saving, smart about investing for a shorter timeline, and importantly, being adaptable.
Very adaptable. Things change, markets change, life happens. And for many, given that complexity and the smaller margin for error, getting that personalized professional guidance isn't just a nice to have.
The sources suggest it can be a real game changer.
Yes, helping navigate all those specifics we talked about.
Okay, here's a final thought for you, the listener, to chew on. We talked a lot about the complexities, the risks like sequence of return risk hitting you hard early in retirement. So how might prioritizing resilience and flexibility in your plan, maybe through those income floors we discussed, or a deliberately more conservative risk profile actually become the most critical factor for success when you're starting late? Perhaps even more critical than just chasing the absolute highest possible investment return. Something to think about.